Hi and welcome to Penser Bank in our interview with Fingerprint Cards. My name is Markus Almerud. I'm an analyst here at the bank. So I have Adam Philpott, who is the new CEO at Fingerprint with me. Hi Adam.
Hey, good to see you, Marcus.
So you released Q3 earnings this morning.
Yes.
Puts and take as usual. If we start just framing it maybe, how would you summarize the quarter?
Yeah, probably four things I would call out. First off is, of course, seeing top-line growth year on year in our revenue, 29% year-on-year growth. Obviously, that's really encouraging for us to see. Second thing, we did some refinancing as an organization. I can talk a bit about that later. That put us in a much better position from our financial structure. So that was really encouraging to complete that as well. The third thing I would say is I talk a lot about a transformational plan that I've put in place as part of our Q3 earnings. So a lot in there around how we're optimizing costs driven by some of the margins that we've seen in markets in which we've seen price erosion. So cost optimization, headline of 50% OPEX cut is a pretty significant undertaking for the company and very powerful for our future, I would say. And then a fourth thing I would say is announcing our new strategy, taking a platform approach to how we're going forward as a platform company.
Mm-hmm. And we'll come back to many of these questions during the interview. But if we start just maybe drilling down into the quarter a bit. And what would you say is the status of the mobile market at the moment, and how do you view it going forward?
Yeah, I mean, I think we've been very consistent on this over the last few quarters. There's been a lot of price pressure in the mobile market. That's a challenge for us because it's a big part of our overall revenue profile and our profit stream. And so we see continued difficulty, continued price erosion in that market, still a very volatile market at the moment. And that is obviously, as we've said before, and continues to be driven by oversupply. There's excess inventory still in the market. Now, the good news is we've got our inventory in a pretty good place. We expect to be at what we would consider a normalized inventory profile by the end of this calendar year. That's on target with what we've articulated previously. However, we see our competitors aren't there yet. They haven't done such a good job in managing their inventories, and therefore that's still driving some aggressive pricing as they try and unlock some working capital and get cash back into their business as well. So I do see this continuing for some time. If you're asking, are we out of the woods yet? The answer is no, we're not.
Okay. But gross margins are still stable. And mobile is growing. It's growing quite rapidly. Does that mean that also the gross margins in mobile is also stabilized?
I mean, as I said, it's a volatile market at the moment, and that's driven by price competition. So we don't offer guidance on our product level gross margin, so I wouldn't want to do that. But what I will say is that we still see it as a volatile market, as we see random acts of violence taking place in terms of certain pricing in order to liquidate stock on the part of our competitors. And we see that continuing into the first half of next year.
We talk about the other business lines. You talk a lot about transformation, and you're moving away from mobile and towards PC and access and pay. And access grew very rapidly in the quarter outside of Asia. What's driving that?
Yeah, I would kind of correct some of the wording there. I would say we're expanding beyond mobile, not moving away from it. But certainly, yes, we saw really strong demand in our access business. We actually see that continuing as well. We see some good opportunities in access beyond physical access into logical access too. So there's some interesting dimensions on access for us there. But the bulk of our growth was absolutely outside of Asia for Q3. Asia was a little more challenged, limited construction, and therefore less demand for the supply of physical access biometry, but certainly saw that really starting to take off rest of the world, which is an encouraging sign for us.
And what about pay? Could you give us an update on pay?
Yeah, pay still remains a really big market that we're focused on. We're still seeing, experimentation within that market. We're still seeing organizations start to play around with different types of biometrics on the payment card. I work very closely with our partners. I was with them the last few weeks, talking about that market. So we still see that as a very strong nascent market, but it's still early days in that market. That market is yet to take off in a meaningful way. We expect that to happen happen still. We're all committed to it in the ecosystem, and we expect it to happen, but it's still very nascent and early days for that market at this time.
If we move on to the strategy, because you introduced a new strategic platform in this report as well.
Yeah, that's right.
Tell me about the new strategic direction, and how is it different from before?
Yeah. I mean, I would say as a company in the past, we've been focused on how we take our existing capabilities like fingerprints and do more of them, and that remains a growth vector for us. But of course, you know, there are fewer and fewer new opportunities for that, but there are still some meaningful opportunities. So we see a good opportunity to continue what we're doing and continue to grow in our traditional modalities, but actually we see an opportunity then expand beyond them. But the way we're thinking about this is, instead of looking at these things as isolated elements, is to actually think of them as part of a broader, cohesive and integrated platform. That way we can start to tie these capabilities together in a more meaningful way. That way we can start to extend into different use cases with our customers with new capabilities, and leverage our existing capabilities into new types of customer as well. And it gives us a predictable way for us to expand and diversify our portfolio as well, in such a way that we build out a set of common capabilities that can be put together in different ways for us to explore new market opportunities. So it's really about having cohesion around the things we invest in. And then I would also say it's also about us reimagining those sorts of investments. So as you look at the platform, there are 4 layers. There is the device layer, so there's a hardware layer that's an opportunity. There is the modality layer, so expanding beyond fingerprint and iris and perhaps into things like face. There is an analytics engine layer where we can expand beyond algorithms, beyond machine learning, and expand more into AI and other types of analytic capabilities. And then, of course, there's the data layer. Today we store on the device. In future, we can store that data in different secure ways, of course, as well. All of those are diversification opportunities for us, and we can do those in 3 ways. We can build those capabilities ourselves. We can buy capabilities through acquisition, inorganic, or of course we can partner with other organizations to put these pieces together in a logical solution for our customers. So some very nice opportunities there as we think about how we go to market.
And how does this tie into the cost base? So you have a quite significant cost savings program that you announced, where you're going to half operating cost. Will that not hamper the ability to carry out your work that you just presented?
Yeah, that's a great question. I mean, essentially what you're asking is, can you do more with less, right? Which is a really good question. And of course, something we think about. That the way I view it, though, Marcus, is that we can be more efficient as a company. We can be more efficient as a company. I think as you look at what we're putting in place here, it's not just cost cutting, it's reorganizing as well. So looking at the way the team is organized, I think we can move to a more efficient, agile structure. I think there's a lot around how we operate as a team. So looking at then how we govern that business, of course, as well. I think we can be a lot more efficient in our governance model and actually move to a much more performance-centric culture coming out of that governance model itself. So just a lot of opportunity to be more efficient, more agile, and more performance oriented, I would say.
And then finally, maybe the financing. You mentioned it a bit. So you finalized the financing and you paid back the bond.
Yes.
Any comments on the financing that you finalized?
Yeah, I mean, that was a real highlight for us as well. It was something that's been in the works a little while. So we were able to repay the 300 million bond. We managed, with the new financial arrangements, to reduce our interest by 70%, almost 30 million annualized. So, you know, really impressive to kind of liberate ourselves financially there, but also have a more flexible arrangement in terms of how we think about that financing, how we can use it. So I think, you know, really pleased with that refinancing, and that really ties to then this more efficient organization, this more performance-based governance, and a focus on executing how we expand in a thoughtful and integrated way across that platform strategy.
Excellent. Adam, thank you for coming to talk to us. I look forward to digging more into the new strategy.
My pleasure. Thank you, Marcus. Great to see you again.
Thank you, and thank you for listening.
Thanks.